Which one is better for you between SACCOs and money market funds? If you are stuck between choosing either SACCO or money market fund for your investment, then this video is for you. Now, I break down the pros, the cons, and the fact that you need to know before deciding whether to invest in a money market fund or to invest in a SACCO. Now, currently in Kenya, financial empowerment is a top priority. Why? Because people are realizing the benefit of the financial literacy and having the desire and the need to empower themselves financially. And now this brings up the choice of where to invest. And when you learn to invest whatever money that you have, it can literally shape your future. Learning to invest in any vehicle that you decide to invest in. Now, two of the most popular options in Kenya right now as we speak are either the Sacco or money market funds. Though there are other avenues, but these ones are most common to the current in the current times. So, which one of these stands out for their in terms of the accessibility, risks, and returns? But which one is right for you? Which one is safe for you? Which one is right for your money? So let's get this party started. Now, what are they? Let's look at SACCOs. Now, SACCOs are member-owned financial cooperatives. When you are part of a SACCO, when you have an account in a SACCO and you're saving, you are part of that SACCO. That's why we say that SACCOs are member-owned, and then they are cooperatives. How do they how do they operate? SACCOs pool savings together so that they're able to provide affordable loans and pay dividends at the end of every financial year. They are regulated by SASRA and they are deeply rooted in the Kenya's financial culture. Now, members, be they teachers, policemen, doctors, nurses, contribute savings as well as share capital. There are two contributions that are made in the savings and share capital, and in return, they earn either dividends and interest. Usually, these payouts normally happen at the end of the financial year, as I've said, annually. Now, let's quickly jump to money market funds. Money market funds, on the other hand, are unit trust investments that are managed by professional fund managers under CMA. Now, they invest their money in various assets. They invest in treasury bills, they invest in fixed deposits, they invest in commercial white paper. What makes money market funds attractive is that the liquidity and the stable returns. Liquidity means that you are able to get your money as fast as you need it back. The interest in money market funds is compounded daily, but and then credited on a monthly basis in your account, and this makes them a very great alternative or options for short-term investment goals. Now, I want us to go to section 2 where we are comparing the returns for the SACCOs and for money market funds, and I'll base these statistics on 2024 financial year. Now, starting with SACCOs. In 2024, the average dividends paid by SACCOs was as high as between 10 to 12% on the share capital, with interest on the savings ranging between 8 to 10%. Have a piece of paper and a pen to get these values. For instance, one Kenyan earned 63,000 shillings in dividends in just 1 year. But this, how important is this? Because returns normally vary depending on the performance and the management. Returns are not fixed; they'll depend with the performance in that particular financial year, how the SACCO has performed, and so it will determine the interest rate that it will pay or the dividend that will be paid at the end of that financial year. Now, let's jump to money market funds. Money market funds have been giving an impressive payout. A Tika money market fund, for example, what I use, I'll attach a video here or here, how to invest in a take money market fund. Paid out around 16.65% average daily yield in May 2024. Sacco money market fund paid around 15.58% in early 2025, while NABO money market fund paid over 15% as well. Now, after tax and fees, investors pocketed roughly between 10 to 13% across all the money market funds that we have in Kenya. We have a couple of them. And that is slightly above the inflation rate. The inflation rate in 2024 was about 5%. So if a money market fund or any asset class pays you anything above that, now that these ones paid 10 13%, is slightly above the inflation rate, which means that you still have some returns from your investment. But remember that money market funds returns normally fluctuate with the market conditions. They are not cast on stone. They're not fixed the way we have got the government bills and bonds. These ones, they fluctuate. Now, there's a mind-provoking thought here. SACCOs can sometimes offer higher dividends, but they depend on the cooperative success. Money market funds, on the other hand, they provide a steady, daily compounded interest. But at the mercy, money market funds returns are always at the mercy of the market rates. When the market rates are good, money market funds will pay out well. But when the rates are not good, money market funds will dip down. So ask yourself this question. Would you prefer a variable but possibly higher returns, or consistently predictable returns at the end of your investment journey? Section 3. Now let's look at the risks, and we shall start with the SACCOs. Now, poor governance in SACCOs will always lead to losses. Earlier this year, or it might have been last year, there is a SACCO that was mismanaged, and one of the management teams, managers, something of sort, took some money from the SACCO, and this ended up affecting all other members of the SACCO. So poor governance can lead to losses. Risk number 2, liquidity is limited. Your money is often locked, and you can't withdraw that money as quickly as you might need that particular money. Then risk number 3, loan defaulters or loan defaults can reduce your dividend. If you guarantee someone a loan and they default on that loan, the amount of money that you might actually be deducted your dividends, or you might be deducted some of your savings. So those are the risks under SACCOs. Let's look at money market funds. 3 risks. Risk number 1, market fluctuation can lower yields. We've said that the returns on money market funds keep fluctuating depending on the market. So those fluctuations can lower the yields or the returns. Then management fees can also eat your returns. They have got a management fees. This can be either 2% or 5% on the returns that you get. So it will slightly reduce your returns. Then finally, returns are not guaranteed. There's a thought-provoking point that you have to understand as we finish the risk. SACCOs will tie your money to people's behavior, while money market funds will tie it to the market dynamics. So the big question is, which risk are you more comfortable with? Are you comfortable with the human factor risk, or are you comfortable with the market volatility risk? The decision lies with you. Section number 4, we are looking at accessibility, and let's start with SACCOs. Now, when you look at SACCOs, membership often depends on your employer or the community that is around you, be they teachers, be they doctors, be they nurses, or people in a particular locality. Now, another point under accessibility, that minimum monthly contributions normally start from around 1,000 shillings. There might be SACCOs that value is lower. Then finally, SACCOs will shine when it comes to loans, and they'll offer 3 to 4 to 5% times your savings at a very low interest rate. Now let's jump into money market funds. They have got low entry barriers, and for as little as 100 shillings in some funds, you can enroll in one. You can be in one. Then withdrawals are within 24 to 72 hours, and this is perfect for emergencies. And then finally, many are digital, and they've got applications, they have got dashboards that you can easily access, and the transaction is basically connected to an M-Pesa for you to withdraw your money. There is a thought-provoking point again. SACCOs build community but limit liquidity. SACCOs build community but limit liquidity. Money market funds, on the other hand, are very flexible. They give flexibility, but they don't have loan benefits. Now, what matters more to you? Are you able to afford credit, or do you want quick access to cash that you have put somewhere in case of an emergency? Now, Section 5, under age recommendations, who should invest where? Now, if you are aged 18 to 30 years, SACCOs would be very great for you because of disciplined savings and loans if you want to grow. Money market funds, on the other hand, are excellent for building an emergency fund. If you are between 30 to 50 years of age, SACCOs will help you with loans, whether you want to buy land, you want to boost a business, or you want to just have a project and you want a loan, SACCOs will be good for you. But money market funds will enable you to diversify your savings in different asset classes. Pre-retirement, 50 plus, SACCOs are very good and ideal because of steady long-term savings, but money market funds will provide you with the liquidity and capital preservation of the money that you have. Remember, with money market funds, it's much safe because capital is preserved and you can't lose your capital as compared to other savings avenues of assets classes of saving money. Now, practical steps. If you want to join SACCO, you research, you join a particular SACCO, you save consistently, and then attend the AGMs to know what is happening. To start saving in a money market fund, just compare the funds, the NABO, the Tika, Old Mutual Funds, NCBA, all banks have got money market funds, Britam. Compare the funds from different firms, sign up via an application or USSD. They'll give you a dashboard, which then you'll be able to manage your fund, deposit, and monitor your performance. My recommendations: for short-term goals like emergencies or school fees or quick access cash, money that you can access quickly, money markets will always win because of the liquidity aspect. Now, but for medium term goals like buying land, saving, or buying property, a mixture of the two. Having some money in the SACCO for development and then having some money in the money market fund will work best for you. Now, for long-term wealth building and growth and development, SACCOs will outshine and will score higher as compared to money market funds. Final thoughts. At the end of the day, choosing between a SACCO and a money market fund depends on your goals. Your risk tolerance, and the stage of life at which you are. For most Kenyans and any other people who are actively investing, the best move is not either or, but both of them. Use money market funds for liquidity and use SACCOs for long-term growth and affordable loans. So, what's your pick? What would you decide to start with, SACCOs or money market funds? Drop your thoughts. I would love to have a look at it. And thank you for watching, and I'll see you in the next video. Let's keep being empowered financially. Until next time, bye bye for now.